Hey everyone, and welcome back to the channel. Today, we're diving deep into stock that's popped up on our hard-to-borrow screener exhibiting some truly fascinating characteristics. We're talking about Global Interactive Technologies Inc., or GITS. This is a unique opportunity to understand the mechanics behind what makes a stock hard to borrow and what that could potentially mean. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's start with the basics of Global Interactive Technologies Inc. Show GITS logo/info card. GITS operates in the communication services sector, specifically within internet content and information. Through its subsidiary in South Korea, the company develops and operates Filings, a digital fan engagement platform. Think online communities, content sharing, and user interaction, all built around fan culture. With a market cap of just $7.06 million, GITS is a micro-cap company, which often means it can be more volatile. Looking at recent price action, GITS closed today up 4.4%, which is certainly a move. However, over the last 5 days, it's down 2.83%. Zooming out a bit, it's actually up a healthy 28.75% over the last 30 days. Now here's a crucial detail. Today's trading volume was a tiny 8,623 shares, which is a mere fraction less than 1% of this 30-day average volume of 1,360,254 shares. Your volume chart. This extremely low relative volume is a key piece of the puzzle we're about to unpack. What is cost to borrow and why it matters? So, what exactly is cost to borrow? When a short seller wants to bet against a stock, they first have to borrow shares from someone who owns them. They then immediately sell these borrowed shares, hoping to buy them back later at a low price and return them to the lender, profiting from the difference. But borrowing shares isn't free. The cost to borrow (CTB) fee is an annualized interest rate that short sellers pay for the privilege of holding a short position. When this fee is high, it tells us that demand to short a stock is high, or the supply of shares available to lend is low, or both. And yes, these fees can absolutely exceed 100% annually, sometimes even reaching into the thousands, because it reflects a real-time supply and demand dynamic for the specific shares. Why this stock is hard to borrow right now? This brings us directly to GITS. Our screener flight GITS precisely because of its incredibly high cost to borrow. Currently, the annualized CTB fee for Global Interactive Technologies Inc. is a staggering 939.4%. Highlight CTB. Not only is it high, but the CTB momentum has jumped by 58 percentage points over just the last 5 trading days. That's a rapid increase. Even more compelling is the scarcity. As of right now, there are only about 200 shares of GITS available to borrow. Highlight shares available. Compare that to its estimated float of 2.4 million shares. With such a limited supply of shares to short and such a high fee, it signals intense pressure on those wanting to bet against GITS. Our internal composite squeeze score for GITS currently sits at 52.6 out of 100, indicating a moderate but notable setup. Squeeze mechanics explained. So, how does this high cost to borrow translate into a potential short squeeze? Imagine a scenario where a stock like GITS starts to move upwards. Short sellers, who borrowed shares and sold them, are now losing money as the price rises. As the stock climbs, their losses mount, and the daily cost of maintaining their short position at 939.4% CTB fee starts to bite even harder. If they want to limit their losses or avoid paying these exorbitant fees, they are forced to cover their short positions. Covering means they have to buy back the shares they initially sold on the open market. When many short sellers are forced to buy back shares at the same time, it creates a sudden surge in demand, which can drive the stock price up even further, creating a feedback loop known as a short squeeze. This process is amplified when there are very few shares available to borrow, making it difficult for new short sellers to enter and for existing ones to find liquidity. Dilution risk check. Before getting too excited, it's crucial to consider dilution risk. Dilution occurs when a company issues new shares, increasing the total number of outstanding shares. While it can raise capital for the company, it also reduces the ownership percentage of existing shareholders and often puts downward pressure on the stock price. This is vital for a short squeeze thesis because if a company issues a massive number of new shares, it can flood the market, providing ample supply for short sellers to cover their positions without driving the price up, effectively killing a squeeze before it even starts. For GITS, we've checked for recent dilutive SEC filings like SMINUS-1s, SMINUS-3s, or 424Bs within the last 90 days, and we found no recent filings that would raise immediate dilution concerns. That's a positive sign for the squeeze potential. We also noted no recent reverse splits for GITS. Again, I want to emphasize. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. A high cost to borrow like the 939.4% we see with GITS, coupled with only 200 shares available to borrow, is certainly noteworthy. However, it's important to remember that a high CTB does not guarantee a squeeze. It could also mean that short sellers have very strong conviction in their bearish thesis and are willing to pay these high fees because they expect a significant drop. The extremely low volume of GITS today, at just 8,623 shares compared to its average, is also a double-edged sword. It suggests low liquidity, which means any buying pressure could have a magnified impact on the share price due to scarcity. However, it also means there isn't much trading interest, which might be a concern for sustained momentum. We'll be watching for any increase in buying volume or significant price increases that could trigger short covering. So, there you have it, a detailed look into Global Interactive Technologies Inc. and why it's appearing on our hard-to-borrow screeners. From its digital fan engagement platform in South Korea to its eye-watering 939.4% cost to borrow and critically low borrowable share count, GITS offers a fantastic case study in market dynamics. This situation highlights the intense pressures that can build in certain micro-cap stocks. If you found this breakdown valuable, please give this video a like, subscribe for more in-depth analyses, and let us know in the comments what other stocks you'd like us to investigate. Your questions help us learn and grow together. Thanks for watching, and we'll see you in the next one.